Okay, folks, welcome to Thursday Night Stock Charts Live. This is Bob Desmond, and this is where we review the weekly charts of the major averages, including the bond market, the yield curve. I want to go over the yield curve tonight. I'm going to go over that in a few minutes. We're going to go over my thoughts with regard to volatility and what may drive volatility in the next 2 weeks, within the next 2 weeks. And I think it's already begun. And I'm going to share with you an article off of zerohedge.com. I want to go over also 3 trades that we... Hey, RL. Thank you, brother. I want to go over 3 trades that we're looking at. Possibly Bitcoin, TZA. TZA is a leveraged ETF, putting you short of the Russell 2000. And also Apple, which I have been speaking about. I've been saying that it's overbought, but you can't short it yet. And I stand by that tonight. So I wouldn't go shorting it right now, but the time is coming fairly soon. So let's do a quick run through of how we look on Thursday night, weekly view. And what this tells us is how we might want to position ourselves on Friday for next week, assuming that we close at or better on the averages, or if we pull back, maybe we want to reevaluate whether or not we want to execute on a long trade. It may look good on a weekly chart right now, but if you get a pullback tomorrow, maybe that's off the table. So this is our cursory review. Then over the weekend, we do the week ahead commentary. That goes out to members, and that really seals the deal of what our strategy is going to be in the new trading week because we have all the data at our disposal. Let's open it up first with volatility. And volatility might come from an area where you don't think it should come from, and I think that it's a fallacy, and that is with the impeachment trial of the president. Now, you may be saying that the Republicans are going to acquit. You don't know. You just don't know. I mean, pox on both sides of the political aisle. I'm a libertarian. I support the president. I don't think he should be impeached, but there are powers that are out there that want him gone. There are powers that are out there that are helping support apparent felons and ex-presidential candidates and current presidential candidates, and they can't get convicted. They can't get what's the word? Indicted. But they want to remove a sitting president of the United States. So the power that is protecting those that should be indicted is probably some of the same powers that are trying to remove the president from power. And it all begins here. And it goes back to Eisenhower, President Eisenhower in his closing days as president. Beware of the military-industrial complex. Now, because I say that doesn't mean I don't support the military. Of course I support the military, but the profiteers, those that want to profit from ongoing war after war after war after war, there's too much money in it just to stop doing it. And the problem is with this country right now is they want guns and butter. They want military and they want to have a welfare state at the same time. That's why this market is setting up, maybe not this year, maybe not next year, but it's setting up for a dismal, dismal crash. And it's going to be a sad one because we are bankrupt and it's the ongoing wars and the welfare state that has propelled it. So Trump steps back from the edge. This is with regard to Iran. Neocons rage accordingly. They're ticked off. They wanted a war with Iran. They didn't get that war. So you have John Bolton, the ex-advisor to the president, who is ticked off at the president. This guy never met a war he didn't like. And expect him to come walking into next week's trial as a witness against the president in all probability. So what they're going to try to do is they're going to try to make it as difficult as possible for the Republicans to acquit the president. And they're going to do things like this. Here's an article out just a short while ago today. Federal watchdog finds Trump administration illegally withheld assistance from Ukraine. Is this new information or is it old? Is this going to be a drip, drip, drip of new so-called evidence against the president during the trial? Will we ever find out really the truth until after he's out of office and there was nothing there? This is what we need to fear, folks. And for those that are buying up this market right now, I'm going to go over some charts tonight that should have your head spinning and saying, what the heck is going on? Especially after we had this report out today. Surprisingly ugly. U.S. freight shipments plunge at fastest rate since 2009. And they hit levels not seen since 2011. Hey, Pat. Good to see you. So, here's a chart. You know, can we bounce back? Sure, we did in 2017. But this is absolutely dismal. This is off of Zero Hedge, but the provider is wolfstreet.com. They usually provide some pretty good content. So with this, you would expect to see the Dow transports. Maybe they took it on the chin today. You would think intuitively that the transports should be getting beat to death. Let's take a look at the chart. And you may be saying, you know, dude, you're a technician. What is the economic data? What is the political data have to do, a political environment have to do with technical analysis? Well, when you are able to take a look at these charts and you just say, there's just no reaction to the data that is coming out, and that could be a tell. Sometimes that's a tell. The markets are shrugging it off because they're looking down. The market's a forward-looking indicator. They're looking down the pike. But when you take a look at the Dow transports on a weekly basis, this is a beautiful chart. It's a beautiful chart. However, let's change up these Bollinger Bands a bit. We'll go to a 3 standard deviation Bollinger Band. Not too bad on a weekly basis. There's more upside here. But when you take a look at a daily chart, remember what was released today. I'll repeat this again. Surprisingly ugly U.S. freight shipments plunge at fastest rate since 2009, hit 2011 levels. Let's go back to the chart. We are trading at current up and into the 3rd standard deviation Bollinger Band on a daily basis. This is just insane. This is just absolutely insane. And it's being done on volume. Now we have to ask ourselves the question, why? Why? Why is this happening? Look no further than those who are supposed to salvage or save the economy during times of trouble are those that are causing the mess. The Federal Reserve. Here you have the Federal Reserve balance sheet. Let's go to a 1-year view. Here's since 2004. Here's the financial crisis. Let's go to a 5-year view. You can see that we pulled back. Now we are well over since a low of $3.769 trillion in September. Now back above the $4 trillion mark. I'll give them credit. We actually went down this week. We actually went down by about $2 billion. But this is the reason why the markets are doing what they're doing. Let's go back to the charts. But all the while, as the Federal Reserve is priming the pump, there's an event unfolding, and nobody's talking about it yet. And they're not going to until the event happens. And that event is the yield curve is yet again beginning to break down. And for those not familiar with the yield curve, pretty much every recession since the 1950s has been accompanied by an inversion of the yield curve. Now, just because a yield curve inverts does not mean you short the market. What you do is you wait for, traditionally, a W formation. I know there are people out there saying, this guy's repeating himself again. I'm going to repeat it 10 more times over the course of the next couple of weeks because it's worth pounding the table on. It's too important to ignore. Typically, you get a W formation that sets up. Hey, Sam. Hey, Pat, looking to have some 32 expire worthless tomorrow. You sold the 32 calls, Pat? What we're talking about is NUGT, the leveraged ETF for gold miners. I'll wait for that response. They rallied into the close in after hours. The 32s are 3250s. So what happens with the yield curve is you usually get a double bottom setup or a W formation. Case in point, 2000 we inverted once. 2001 we inverted twice. Then as we began to steepen, that's when, overlaid here in blue, right? Is that the way I have it set up? Yeah, in blue, is the S&P 500. And that's when the S&P 500 rolled over. Fast forward to the financial crisis, first leg of the double bottom setup, second leg, steepening. We all know what happens next, right? It was not pretty. Here we are today. Here's where we closed out. Well, let's start with the first leg. Here's the first leg of the inversion going back to August of last year. We've rallied. Now, at current, the month is halfway over. A lot can happen. Maybe we'll rally back. But at current, we're beginning to break down below support levels. So what I'm thinking now is that we could quite possibly be on our way to that second leg of a W formation. What do I want to be doing in that environment? I don't want to be shorting with reckless abandon. However, I do want to be setting up a strategy to short the market as it begins to break down, as the yield curve begins to steepen yet again, because in all probability, we will be in recession. Oh, okay, I see what you did. So you sold the 32s. You didn't go, that's right. You're like me. You don't sell the entire position. Right. Okay, good. Good. So you made money. Good for you. And even with the premium, even if they expire, below 32.50, you're still ahead of the game anyway, right? Or break even, you made money. So even if they got called away, sell the puts next week at the 32 strike, and you're back in. Or the 32.50s, one of the two. So, yeah. Congrats. Good trade. Oh, I see we have a bunch of people that joined in. Folks, if you could please hit that subscribe button, I really appreciate it. It helps me out with the YouTube algorithms. Thank you very much. RL, thank you as always. Let's go to another chart. We're going to go until about 6:30 tonight. Another chart that should have people a bit concerned. And this is why I'm looking short-term to the short side. And if you're asking why with my doom and gloom with regard to freight cars this and yield curve that, it's because you have an election in front of us. I'm not going to ignore the fact that we have an election and they're going to rig this market 6 ways from Sunday to make sure it's rallying into that election. It's a foregone conclusion, absent a geopolitical event. So the VIX. you have the S&P 500 at all-time highs. We closed out the day today. Well, on a weekly basis, we appear to be at the highs. On the day, at the highs, right? But what's the VIX doing? The VIX is setting up a W formation. You know, maybe this won't hold, but this is what I'm looking at right here. We rallied off the lows of the day, and there have been several times over the past couple of weeks where the S&P 500 is traded up, and so has the VIX. So we are consolidating here. This to me is like a coiled spring. So somebody is out there doing some stealth accumulation of insurance, buying the VIX, just in case this S&P 500 rolls over and they're staying long of the market. And they're going to let the market take them out and they'll be hedged to the downside. But this is not mom and pop setting up these trades. These are institutions. Now, when you take a look at the IWM, this is the ETF that tracks the Russell 2000. I mentioned the other day, it looked as though it was going to break out. It did break out. I wanted to buy it. I couldn't buy it. And the reason was that we have been leaning into the third standard deviation Bollinger Band. I've mentioned that like 5 times already on this video. I get it. Why does it matter? If you're not familiar with it, I'll save you the technical jargon. We're not supposed to be here. This is not going to last. Are we going to crash? I don't know. I don't think so. We have an election ahead of us. Are we going to pull back? You darn tootin', we're going to pull back. It's going to happen. So it could happen tomorrow. It could happen next week. I'm not that smart. But it is going to happen. And we are looking to short the IWM fairly soon using the TZA. And let's go to, do I want to go over anything else here? Oh yeah, let's go over gold and we'll talk about the short in a moment. Gold weekly chart, we're bullish on gold. It is down in the week now. This hasn't been updated though, has it? Let's go to the GLD. Yeah, this is better. We're off the lows of the week. So we are down about just shy of a 0.5 percentage point on the week. And we're consolidating nicely. We are long of the gold miners. We'll bring up the chart of the GDX. And the GDX so far this week, we're using a leveraged ETF with our service. But if you're risk adverse, just use the GDX. And we are very close to flashing a bullish key reversal. And I think that we are going higher here very, very soon. Very nice chart. So while gold is down slightly on the week, the GDX is trading just shy of the highs of the week. Very pretty chart. So this is why we're looking at the weekly charts to try to ascertain how might we close out the week. Do we want to add to our position? Or if we pull back, do we need to lighten up? Pat is a member. We sell a lot of covered calls on our positions. So will those expire worthless? Should we let them expire worthless? Or should we buy them back? You know, these are the reasons why we close out the week on a Thursday, trying to take a look at those Thursday evening charts and the intraday charts as well, trying to determine whether or not we're going to have a strong close to the week. And when you take a look at the daily chart of the GDX, we were down today. Inside day, no new high, no new low, but we closed well off the lows of the day. Stokes are rising, still down below the 50 mark. Not my favorite setup on the Stokes, but the price action trumps all. So this price action here is very, very pretty. Down volume today, light. So we're bullish on gold, bullish on the miners. And let's take a look at Apple and the TZA. I just spoke about the TZA. Let's go through it first. And again, the TZA puts you short of the Russell 2000 to leverage ETF. If you don't want the volatility, simply short the IWM. Where is it? Here it is. All right, so here's our weekly chart. Admittedly, this is ugly as sin. This is ugly. This is an ugly chart. We are at the lows, all-time lows, on the TZA. This is a trading vehicle. Daily chart. Daily chart, week. No, that's the wrong chart. Sorry, it's labeled wrong. Okay, daily chart, week. However, where are we? If I'm bearish on a stock or an ETF that's trading above its third standard deviation Bollinger Band, that means I'm looking pretty curiously at an ETF that is trading down below the third standard deviation Bollinger Band and is due for a correction. Are we ready yet to go jumping in and buying up the TZA? Soon. We'll do more intraday analysis to see whether or not we're getting any intraday divergences, meaning is RSI putting in higher lows and higher highs, and divergences like that, which would indicate to us that the selling pressure intraday is beginning to alleviate, and we could begin building a position to the short side. But at current, I would ignore the volume on the TZA, and I would defer to the volume on IWM to determine the health of this rally. And the volume today was pretty healthy. Were it not healthy, I may have been buying up the TZA today. I was not. So this is one that we're looking to put on as a trade, shorting the Russell 2000. Again, is it a bet that it's going to break down to new all-time lows, or a bet to break down below 163? No, it's a short-term swing trade. That's it. The big trade will come later on in the year. Let's bring up Apple. Now, Apple is one that is extremely overbought. RSI at current is 76.90. And you may be saying, technical analysis for dummies says the shortest stock was above 70 on RSI. Wrong. It's going higher. It had RSI well above 80 several days ago, and I didn't short it then. It's out of respect because the markets are irrational right now, and we just don't have the indicators just yet that this stock is ready to break down. They're beginning to build declining MACD histogram, light volume today. Stokes beginning to weaken up. And the real catalyst, or the real reason, not catalyst, the real reason why I want to short Apple is not the daily chart. It's the weekly chart. And ideally, we short as close to earnings as possible. Rarely do I short a stock or buy a stock into earnings. I don't play that game. I think that's a net money loser. My one caveat to that rule is when you have a stock that's trading at nosebleed, unsustainable levels. And in the case of Apple, when you have an RSI at 89.64, I don't care if they beat on numbers. There's going to probably be a sell the news event. So they'll probably pump it up into earnings. Earnings are reported, I believe, on the 28th. I would check that, but I believe it's the 28th. And the closer we get to earnings season or earnings reporting, the better before we open up this trade. So until that time, we'll be watching. If we begin to see divergences on the charts intraday, maybe we'll begin opening up that position in advance of earnings, several days in advance of earnings. Ideally not. I would like to see this sucker get as pumped up as possible into earnings, because then I think that we get a sell-off on that event. And with that, let me take a look at some comments. Sam, amazing futures. The futures are up. Let's take a look. Yeah. Yep, looking good. Okay. 29th is, Sam, 29th is Apple earnings? Okay, cool. Thank you. All right, with that, folks, if everyone could hit that like button, I'd really appreciate it. I want to thank you for joining in. Members, we're going to start the members inner circle at 7 p.m. I'm going to send you out a link in a few moments. IBM is getting some traction. Let's bring up IBM really quick. Nice day today, IBM. You're right, Pat. I agree. Yeah, they're going to move up higher. I like IBM. Good stuff. Thanks for that. With that, folks, everybody have a profitable trading day tomorrow and a profitable trading week. Be well.